Okay, so this is our class number 3, the history of risk. And what I want to do here is take advantage of a really excellent book that I do recommend by Peter Bernstein. It's called Against the Gods, The Remarkable History of Risk. uh, I have this book. Not only do I have it and have read it, but it's actually autographed by Peter Bernstein himself. I attended a conference where Mr. Bernstein was speaking, and I had no idea he was speaking at this conference, and I just happened to have the book with me because I was reading it at the time. So I had him sign it. He wasn't all that thrilled to sign it, I could tell, but still I have his autograph. He passed away several years ago, but this is still one of his great books. He's a very good writer. He doesn't write overly technical, though he does cover a lot of very technical material. He just writes in a very readable way. He definitely has the quantitative chops to handle this material. The conference that I saw him at was an actual science conference, so a lot of very mathematical people, and they asked him some really tough questions at the end, and he handled them with no trouble. So I want to take advantage of his book to cover some key concepts from the history of risk. This will be an exam question to select some of these and talk through them. And really what we're looking for is define them, understand what the concept is, and then understand how we apply them in finance. And we use a lot of these, we use these all the time in finance, but then also understand how we often misapply these in finance. So we'll go through each one of those. The statistical inference and law of large numbers, you should have had that in your statistics class. Hopefully you remember some of that. Reversion to the mean is not always covered in statistics class. It's a huge issue for finance, but a lot of statistical applications don't really think about it. But we'll talk about that. And then obviously real important, and we'll talk a lot about this later in the semester, about the importance of correlation and this concept of diversification. There's a major essay question that I like to ask related to diversification because it challenges conventional thought, which is something I really want to do in this class, is get you questioning some of the stuff that a lot of times finance and risk management textbooks just take for granted, but have not really worked all that well over time. So let's start with this first one, statistical inference. You probably have heard this term, you used it a lot. This is on page 6 of the class notes. You've used this concept a lot in your stats class. If you've taken any accounting classes, I don't know, any of you are accounting majors or have taken an auditing class, there's a lot of statistical inference in auditing. So what you do basically is you take a sample from a population and you try to apply that sample in order to figure out the characteristics of the overall population. If your sample size is large enough, then the statistics from the sample size should match the statistics from the population. So obviously if you take a sample size of 300 million people in the United States to try to figure out the heights and weights of people in the United States, 300 million would be an incredibly large sample size. So you would have a lot of confidence that that sample is truly covering the true population and what the population characteristics are. If you only look at 3 people and all from the same city, then that sample size will not give you good confidence that you're understanding the characteristics of the entire population. So pretty basic stuff. It's sampling techniques using statistics that you probably had in your statistics class. Hopefully you've had something along the lines of how large should the sample size be, and that's going to be based on the population, the standard deviation expected in the population. There are certain statistics that we have to try to help us with that. So how do we use this in finance? Well, we use this in finance by taking history. This is real key. Taking history as our sample, and we're trying to get to the population, which is the future. So already we have a huge problem on our hands. We're using history as our sample to predict the characteristics of population that our sample wasn't drawn from. we don't draw our sample of history from the future, we draw it from the past. So there are several problems with that, but that's what we do. So our historical data is our sample, our population is the future we're trying to forecast. So how many years back do you go? How many months back do you go? When you do paper 1, you're going to see banks talking about value at risk. And one of the things you want to capture is how far back do they go? Most banks use a statistical value at risk called historical value at risk. How many days do they go back? Some go back 100 days, 300 days. How far back in the past do they go to try to get a sense of what could happen going forward? But the problem with that is if you have a sample of 50 years, is that a sample size of 50? Or is that really just a sample size of 1? Because the last 50 years could have been one unique period of 50 years. The 50 years might not have been uncorrelated, so that's another big issue. One year might be influencing the next year. So how much confidence do we have that the last 50 years really tells us the characteristics of the next 50 years? Obviously, the world has changed quite a bit. So how large of a sample do you need of the past? Well, let's say we take, instead of the last 50 years, we take the last 500 years. Well, then we have a serious problem where the Industrial Revolution really got going in the 18th century. If you go back 500 years, you've got a couple hundred years there without the Industrial Revolution, without markets like we really know markets. And then technology of the 20th century obviously changed things. So does really going back further in the past giving you more confidence, or does it maybe actually even make it worse? So it's a tough thing that we do. We do it all the time and we rely heavily on this, but it is a problem with our analysis. So what are the problems? So that's how it's applied. This is how we do this. We use the past to predict the future, even though we know that the future is so different. So what are our problems? The first problem we have is a sampling error. We're drawing our sample not from the population, but for something we think is similar to the population, which is the past. Our population is the future. So we assume the past predicts the future. Now, no other place would you do this in statistics. So if you're trying to figure out the average height of a person living in the United States, you wouldn't go, I visit Costa Rica a lot, you would not go to Costa Rica and sample 1,000 people there. I know when I go that Americans, U.S. citizens are taller than Costa Rican citizens, at least in the area I am. I feel like a giant when I go there. I'm a good, I'm about average, a little bit tall in the United States. There I'm very tall. I tower over a lot of people. So if you drew your sample from Costa Rica to try to forecast the United States, there would be an issue. You're not drawing your sample from the population, and the population doesn't look like the sample. And that's in essence, that's what we're doing with the sampling error here, is we're drawing our sample from something that may or may not be like the population. And then with Costa Rica, actually, I can prove that Costa Rica is different than the United States because I have data to prove it. But there's no way for us to prove how much error we are bringing into the process by relying so heavily on the past. Obviously, that's all we can do. We cannot draw our sample from the future. We'll talk about stochastic value at risk. In some ways, we might try to use simulation, but even simulation is heavily reliant on our past data. We rely heavily on the past to try to predict our futures. If you looked at 2020 with COVID-19, March, April, May, things happened in March and April, May that weren't just different, they were way off the charts. Any kind of historical data that you looked at, the numbers we got for jobless claims and for the GDP for the second and third quarters, the jobless claims, I forget the actual numbers, but we were 3 or 4 times the worst case we'd ever seen. Just numbers that were, 600,000, 700,000 jobless claims in it, when the worst case was less than 200,000. It was just massively different numbers. So there's a case just in 2020. We're just talking, this last year, we have a situation where history did not come close to telling us about what could happen in 2020. The second problem we have is that the world is changing. The averages are changing. Volatility, standard deviations are changing. Correlations, we'll talk about that. Correlations are changing. They change with time. Why? Because we have new technology. Demographics are changing. Markets are changing. Culture is changing. We have environmental issues that might be changing things, like how many hurricanes we have, how many tornadoes we have, how much water drought do we have. They change over time such that history becomes a weak predictor of the future. Again, 2020 is a great example of that. So is the average of the past really going to be the average of the future? Is the standard deviation of the past, the risk, the volatility of the past, really the standard deviation going forward? You know, I ask students, a lot of students in their early 20s, I'll ask them, is the world riskier today or less risky than 50 years ago? And many of them will say, oh, the world's much riskier today. And someone who grew up, you know, I'm 57 years old, I remember the 60s. There were assassinations, there were riots. You know, the stuff we're seeing this last year in 2020 with a lot of the riots and the protests, they're nothing compared to what we saw in the 60s, especially the assassinations. Then in the 70s, we had the high inflation. We had, you know, just incredible things going on. To me, the world was much riskier, much more uncertain back in the 60s and 70s than it is today. But that's a subjective opinion. But that just shows that, you know, someone who's lived through those years has a very different perspective than someone who hasn't. And so, you know, just how we assess history is so different depending on our perspective. And then the last thing, which is a really difficult thing to do, is that history changes the future. When I take a sample of, let's say I do the sample of people, men in their 40s, their heights. I want to know how tall, what the distribution of men's heights in the United States is, people in their 40s. When I take that survey, I go around and measure heights of men. If someone comes in and they're slightly below average and they say, well, I don't want to be below average, and so he changes his height to be above average, well, that's not going to happen. Me taking the sample is not going to cause that person to go away and change their height, because they can't do that. But the simple fact that we have history, that we're sampling history, that we're looking at history, is going to cause the future to be different. Because of 2020 has changed how people invest. The 2008 financial crisis has impacted how people will invest in the future. One thing that we're noticing that may be true going forward or may not, but it's certainly been true the last 20 years, are these very long periods of time with very, very stable markets interrupted by these amazingly high volatile markets. So we just experienced the longest bull market in our history, coming out of the financial crisis of 2008. And there were some years during that time where the markets were just amazingly stable, so calm, very few big days. And then all of a sudden we had 2008, we had 2000 with the dot-com burst, the 2008 crisis, and now 2020. Markets that were far volatile than anything we've seen in the past. And there's actually, we're going to talk about one writer, Taleb, and his ideas about risk. And he has a view that because of globalization and technology and travel and the fact that we're becoming much more interconnected, he believes that is the new pattern. Very, very, very stable periods of time followed by much more volatile periods. More stability, much more volatility. The volatility periods get larger and larger volatility, and the stable periods get more and more stable. That's a very different world than most of finance has been based as far as it comes to risk management. So if the world's really changing like that, that may mean we have to throw out some of the things we've been relying on in finance. But then the issue is, what do we replace it with? And I'll give you some ideas as we go through this class of some alternative ways of thinking about the conventional approaches. But we learn from our mistakes. We're conditioned by our experiences. We behave differently the next time, such that the next time looks very different than the last time. We'll talk on paper one, you're going to be talking about worst case scenarios. Well, the worst case scenario becomes somewhat of an anchor. And we think, oh, 2008 is the worst we're ever going to see. And then 2020 is even worse. The worst case scenario just happens to be the one that we've seen in the past, but it won't be the worst case scenario after the next worst case scenario, and the next worst case could be a whole lot different. And why? Well, because of the last worst case scenario, the next time we go into that environment, people may react even more strongly. They might remember what happened in 2008, and in 2020, they might react much more harshly, much stronger. And we'll see that something like we saw in 2020, where the market dropped so fast and so far in a way we've never seen before. So statistical inference has some pretty serious problems. I'll give you a few hints on things you can replace it with, but there really is no simple fix to this, because we really don't have any choice but to look back at history. And you'll notice that a lot in paper one. That's something I really want you to pay attention to, is how much these large money center banks and large regional banks rely heavily on the past, on history. You can say that's part of why we had a problem in 2008, because people were looking at historical housing markets and saying, no, the whole country's housing prices can't go down at once. It's always diversified, it's regional, and then suddenly the entire country's home prices fell altogether. Right, so that's the very first one, statistical inference. The second one, the law of large numbers, is closely related. So the law of large numbers, in fact, I've really already talked about it, is that the larger the sample, the more closely your results reflect the true characteristics of the population. And in fact, if you watch, if you look through the PowerPoint, I gave you a PowerPoint that summarizes this book. And he talks about one of the Bernelli brothers, or uncles or nephew, I can't remember which one, maybe Daniel, talked about this concept of moral certainty. That if your sample size is large enough, you'll know exactly what the characteristics of the population is. It's just like a game of chance throwing dice. We know there's a 50% chance, if you're flipping coins, a 50% chance of a heads, a 50% chance of a tail. If you're throwing dice, there's 6 sides. If you have 2 dice, the number 7 is the most likely to come up, and 12 and 2 are very unlikely to come up, just because there's not as many combinations. As long as the dice or the coin are not fraudulent, there's no funny business going on. We know with great certainty what the true distribution going forward is going to be, and we can make bets. But can we actually get that kind of moral certainty when we're talking about stock markets and bond markets and interest rates and human behavior? We'll talk quite about this later when we talk about behavioral finance and behavioral economics, and how our biases tend to make things happen in ways that are unexpected and not essentially in the way we would expect, given our models and our theories. So how do we apply law of large numbers? Well, we try to get as much data as possible. We're data hungry, so we're trying to obtain as much data as we possibly can. That's probably, you've heard the term big data. So not only are we getting more data, but we're actually letting the computers, through artificial intelligence, scrub the data, assess the data on their own. We don't have to pay them anything. They're doing all this work for us time and again until they find patterns that we haven't discovered. I do encourage you there's some great blogs and some great tutorial videos out there on artificial intelligence and machine learning. I'd encourage you to, if you have not had exposure to these concepts, go out and watch those podcasts, watch some YouTubes. At least get enough so that if you ask about it in an interview question, you can at least say you know something about it. And you don't need hundreds of hours to at least be able to talk intelligently about artificial intelligence and machine learning. But you need enough that you've exposed yourself to it. Hopefully you're seeing some of this in your classes. But obviously this is a huge part of finance. I don't know if you've noticed it in banking yet, but banking is much more relying on artificial intelligence. There's a huge firm in China called Ant, where they rely heavily on artificial intelligence to decide whom to loan money to and whom not to loan money to, and by what rates, based on all kinds of stuff. Social media posts that people do, where they work, where they live. So that's certainly coming around, and a lot of that is really great data. It really does tell us some stuff. The more data we have, the more on certain activities, the more data we have, the probably better we will be at making certain decisions. So if we have fast and powerful computers with huge databases, we're going to be able to explain the entire world. China is becoming a leader in this, mainly because they have the data, and their population is not as skittish about privacy as the West is. And so they have an enormous amount of data that they can draw on to understand these relationships. And so, yeah, we should be able to, with all of this data, be better at managing our businesses, managing our risk. But the problem is, with that much data, you're always going to find some statistically significant relationship. The question is, are you finding something just because you're looking so much, you're bound to find something? You know, with somewhere in the world, there's a 90.99 correlation between two things that are completely unrelated, but just because of pure random chance, they're related. So are we really finding true relationships? Or are we just data mining and finding relationships because we're looking in so many places? So just because a relationship is discovered doesn't mean we bet the farm on it. We've got to step back and ask, is that by pure random chance that those two things lined up? I've seen some really interesting ones. I don't have any to show you that are pretty cool, but there's a couple of related to, you know, how many movies a particular actor did in 1 year explains how many auto accidents there are in the United States. You know, just stuff like that. Getting that from actuaries and just funny relationships that, you know, there's nothing between those, and you can stop and try to figure out some causality between those two. But, you know, if you look at enough data, you're going to find those relationships. So we're getting better at it. We probably are going to find relationships that are very reliable and very powerful in finance, but we'll probably also find some relationships that are just pure random noise that look like the relationship. And so how do we misapply the law of large numbers? We overly rely on statistical relationships that could be random noise, like I just talked about. That's called data mining, where we're just looking at every single possible combination. That's what bothers me about artificial intelligence. The statistics behind it is not all that complex. What's really unique is the speed and the amount of data they can handle. But even once we find those relationships, do we have the confidence to make decisions? And if we do, are we now making decisions that we would have never made before we had this data? So I always think when you're doing this kind of thing, you should wait for at least some out-of-sample confirmation. Hedge funds are really good at this. They'll find a relationship. They'll think it's true, but before they actually implement it in a portfolio, they'll set up what's called an incubator fund, a small fund that does the strategy, but just to see if it actually works in real life. I've seen some, there was one mutual fund I was responsible for that it was over data mined. The guy who built it looked at every single shred of data he had, and he found a relationship that worked. The problem is we couldn't test it out of sample except for in the actual live portfolio. So they actually took this portfolio live, and the only out of sample we did was with other people's money in a live scenario. It ended up actually doing pretty well, but was there truly a relationship there or not? It made me nervous. So I would have preferred that he looked at maybe 20 years, found this relationship, and then we would have tested that in another group of years to see if it was true in different cycles. All right, so that's the second one. Statistical inference, law of large numbers, those two are highly related to each other. Now we get to one that's somewhat unique, reversion to the mean. Reversion to the mean is the idea that there's a natural tendency for data to move back toward its mean rather than continue to move away from it. So if you've had several years of above average stock returns, then you expect below average returns going forward. There's some famous data out there on that. Robert Shiller in particular, he has a database you can get for free. You just type in his name and data, the word data, and he has data back to 1871. And his data does show when you've had a long run of really strong stock markets, the next 10 to 15 years will give you below average returns. It's not real predictable. You can't time the market to the day or even the month. But in general, like right now, we're at the third most expensive time we've ever been. The 2000 crisis, the dot-com crisis, and in the 1929 with the roaring 20s crisis, we're now at the third most expensive time. So people get nervous about that. It's mainly because interest rates are so low, so stock prices are high. But it just makes you nervous. Stocks have done extremely well. Even with COVID-19, yeah, that was a big sell-off, 30% sell-off, but the markets have come back and have hit new records, so we've come back really quickly. Well, that really changed people's behaviors since it recovered so quickly. But that's what we're looking at is you see something that's been above average for a while, you expect it to be below average. That's something you'll have to deal with the project we're going to have in risk management. We're going to do some attribution analysis. And one thing you might want to look at is if you're looking at a mutual fund that has had a recent really strong performance, should you be worried about reversion to the mean? So how is reversion to the mean applied in finance? What we do is we recognize it. We make it part of our models. I had some models that I ran at UTSA where we specifically included the concept of reversion to the mean. So if interest rates have been unusually low, you would expect them to be higher going forward. If a portfolio manager has recently had really strong performance, you would expect him or her to have below average performance going forward. I've seen that many, many, many times. That one seems so true. In fact, the worst time you can invest in a portfolio is right after it's had 2 or 3 years of really strong performance. You're usually better off investing in a portfolio whose last 3 years have been particularly weak, but their longer term performance has been strong. That's probably the best time. And we've seen it here recently because of the FANG. If you've heard of the FANG, Facebook, Amazon, Netflix, and Google, or Alphabet, those 4 stocks plus Facebook, plus Apple, plus a few others have just been going like gangbusters. If you had those in your portfolio, you've done well the last 3 years. If you didn't have them in your portfolio, you haven't done well. So if you buy those managers that have done well recently, you're just essentially going to be betting on the FANG again, those stocks that have done really, really well here recently. But if interest rates rise, those stocks are probably going to underperform and not do well. So, it's a bet on a particular thing that has worked, not necessarily betting on a particular skill that has worked. It's hard to know whether a portfolio manager is performed because of skill or they just happen to be at the right place at the right time. But reversion to the mean usually is a good signal, a time not to invest in a manager. Pension plans, we're going to talk about them in depth, but they tend to have assumptions that rely heavily on the recent past. And we'll talk about why that's the case. If the stock market's done well recently, they tend to assume it's going to continue to do well. And then when the market sells off, the pension plans, like in 2008, pension plans just blow up horribly because their assumptions were rosy, and then the stock market crashes. So we'll get into that more. But that's how it's applied. How is it misapplied? Well, we can never be confident in the timing of reversion to the mean. It can take a very, very long time. So right now, people are talking about how low interest rates are in the United States, but we've been talking about that for a very long time. And in Japan, their interest rates have been low and even negative. And in Europe, we see some negative interest rates for years now. We're going on almost 2 decades here with Japan. So that may be the second issue, that the mean itself may be changing. The world may have actually changed. So I have down here 2 quotes that are the most dangerous things to say in finance. One is, it's different this time. That's what people were saying in 2000 when they were talking about dot-com stocks, and they look so expensive and say, oh, no, they're not expensive. It's different this time. These stocks are supposed to be trading at 70, 80 multiples. And they were wrong. It wasn't different that time, and the NASDAQ sold off 80-something%. But the other thing that's just as dangerous is it's not different this time. No, the world hasn't changed. Interest rates, I know one gentleman who had put all of his clients in cash probably 10 years ago. just saying interest rates are so low, I got to put everybody in cash. We'll just wait for interest rates to rise. And here we are 10 years later. I don't know what he's done, but he went a good 4 or 5 years with that strategy. And boy, he destroyed value for his customers because interest rates just did not rise. He would have been better off locking in those longer term rates that were much higher back then and at least giving a little bit of extra income to his customers. But he didn't do that because he was expecting reversion to the mean and it didn't happen. So good examples like global warming. If global warming is going to really change temperatures, change the size and strength of hurricanes, then going forward, we should be expecting things to be different. It's just the nature of the world is changing. So, so we get above average temperatures for a while, it may not revert back. We had a period there, a very long period there, with very few hurricanes. And then suddenly we had a high number of hurricanes. Is that just normal volatility or is global warming causing it? Those are the tough things to figure out because the data, it's hard to get the data, and plus a lot of this is statistically really tough to measure because things change naturally and revert back. So there's probably some reversion to the mean going on, plus some actual changes, and knowing which is which, scientists really can't tell us that in precision. Now, one other thing to talk about with reversion to the mean that you really should think about is this idea, and I'll type it here, of momentum. I don't know if you've heard the term momentum. You might look that up. In fact, if I were you, I would go out and do a internet search on all 4 of these, plus momentum, and just see what else you can see. Wikipedia is a good place to go. But momentum is, in my mind, is the opposite of reversion to the mean. What momentum says is trends tend to continue. Stocks that have done well tend to continue doing well. Stocks that have done poorly tend to continue to do poorly. So what this means is reversion to the mean. Reversion to the mean will happen, but on the way to it happening, you're going to get further away from the mean before it shifts. So if you bet on reversion to the mean, not only will the reversion may not happen, but you may actually be losing a lot of money because it's still moving further away from the mean. So you've got to be really careful with this concept of momentum. And momentum does exist. There's been many studies that show, and there's a lot of hedge funds that use momentum. If you want to really see this, a famous person on momentum is Cliff Asness. He's at AQR. We'll bring him up probably a couple more times this semester, but yeah, he's a big believer in momentum. It violates the efficient market hypothesis, and people really have a tough time explaining why it happens. There's a few theories out there, but so you could definitely type in Cliff Asness's name and the term momentum, and you would see some articles come up. He's won a lot of awards for his articles because he is a very good writer. I highly recommend you read his articles. Or there's some podcasts out there. If you go to my book reading list, recommended reading list, I have some link to some podcasts, and Cliff Asness is a common guest on these podcasts, and I'd recommend find his name and listen to those podcasts. He's a very good speaker, always has interesting things to say. So reversion to the mean is not a reliable thing. It can actually fool you and get you into trouble, but over the long term, it tends to eventually happen in most cases, unless the world is actually changing. All right, so here we're on page 8 of the class notes, and I'm going to get into the one we're going to definitely spend a lot more time on this one. So correlation and diversification. You may have heard of Harry Markowitz, a Nobel Prize winner. You may have heard of the efficient frontier. If not, you get to build an efficient frontier in this class, so you look forward to that. I'm going to have you do some really real world things on that risk management project, including building an efficient frontier. Efficient frontier uses correlation as its main measure of how to manage risk. The efficient frontier looks at all portfolio combinations, and it's trying to find the highest return at every level of risk And what's managing that risk level is correlation. If you can find assets that are not perfectly correlated, you remember correlation ranges from -1 to +1. So you can find asset classes that are not perfectly correlated. Maybe the correlation is 0.2 or 0.3 or even -0.2. And we'll talk about that with stocks versus bonds. If you have something that's not correlated 1.0, then when you combine it in a portfolio, your risk will be lower than the average of the risk of those two asset classes. So we'll see that. We'll actually look at that mathematically, and you'll see how that works. It's an extremely important term. In fact, I would argue correlation and diversification are the #1 risk mitigation tools in finance. As you do paper 1, you definitely will be seeing the term diversification as a risk mitigation tool, whether it's for interest rate risk or for market risk or for credit risk. Diversification is real important. I have an entire blog on this that I'm going to have you read. It's going to be an exam question, and I'm going to maybe upset the apple cart a little bit here and challenge some things that you thought were already taken care of in finance. And we'll see if I don't maybe get you a little bit unnerved, but that's good. We should be thinking about these things. You might go back and agree with the old school way of doing things, or I'll give you some alternative ways of looking at it. So the key here is how are different assets correlated to each other. So correlation is the one, I say one of the most used tools in risk management. It might be the single most used tool in finance for managing risk. So how do we apply this? Well, in finance, we construct portfolios of assets and liabilities looking for optimal strategies. So essentially what you're going to do on the project is you're going to construct a portfolio that's optimal, and you're going to recommend that to your customer. And the correlation assumptions are going to be huge to making that decision. You're going to use my assumptions because I'm going to provide you the model. So you're stuck with my assumptions. I'll show you how I came up with my assumptions when we get to that project much later in the class. And you may or may not agree with them, but you're going to just use them because that's what you have to work with. And then if you want to build your own efficient frontier model, you will have to come up with your own assumptions and decide how you're going to do that. Now, how is it misapplied? Well, it's misapplied because we don't recognize how unstable correlations are. And we'll get into this. Boy, we'll start just with the simple idea of stocks versus bonds. So I asked the question, are stocks and bonds highly positively correlated or highly negatively correlated? And the answer to that question, you'll see, is yes. Yes, they are. It all depends on the environment. And so we'll get into that later in class. In what environments are stocks and bonds highly correlated, and in what environments are they uncorrelated? Right now we're in an environment where they're uncorrelated. So a stock and bond portfolio is going to be pretty good from a risk standpoint, because when stocks are doing well, bonds are selling off. When bonds are doing well, stocks are selling off. But we'll even challenge that concept, because we have to ask the question, what do we mean by bonds? And I'll show you a video from a very famous gentleman in finance, the one who wrote A Random Walk Down Wall Street. And I'm going to show you what he says about correlation, and then I'm going to do the crazy thing and disagree with him. I think he makes a mistake in that area, and so we'll see that and understand why I take a different perspective. All right, so this part of the class, what we need to do is make sure you have some terms down because we're going to use them. We're going to calculate them, use them. You'll see some of these in your paper 1. Definitely we'll be using these in paper 2 as well. We won't be using beta as much in this class. We'll do it a little bit in the project, but not as much. We'll definitely be doing number 5. We'll definitely be using duration and convexity. Well, duration and convexity we'll talk about. And then in your paper 1, you'll definitely be talking about credit ratings. But these are the main tools we'll be working on with this class. So standard deviation is a formula you should know backwards and forwards. So let's think about this formula. What do? You take x sub I. You remember that? X sub I minus x bar. You start with that. So what is xi? Xi is if you have 100 months of data, xi is month 1, then month 2, then month 3. So x sub 1, x sub 2, x sub 3. X bar is what? So xi is each data point. Maybe it's, we'll see when we do the project, we'll be using maybe monthly returns. X bar is the average of the data points. So we start with that. And then what do we do next? Well, the next thing we do is we square it. That's huge for standard deviation that we square that, because what happens when we square a number, you only get positive numbers. So that's really key on standard deviation. You always need to remember on standard deviation that the focus is on the distance from the mean, not whether you are above or below it. So that's really, really huge that you see that. So squaring that difference, there's no way to get a negative number when you square the difference. So if month 2 is 40% and your average is 8%, then you take 0.4 minus 0.08. That's a positive number. You square it. If the next month is negative 3%, you take negative 0.03 minus 0.08, the average. You square that. Again, you get a positive number. The other thing we know is that outliers are emphasized. And I've never been able to spell the word outliers. I don't know why. They're emphasized. Outliers get extra weight. So what does that mean? Well, a year like 2020, where we had some huge months that moved dramatically, those few months in 2020 are going to have tremendous extra weight into a calculation of standard deviation than the months we saw in 2017 and 2016 and 2018. And same thing with 2008. 2008, we saw a lot of volatility, especially the last 4 months of the year. And those months have extra weight just because they're outliers. So that's the key of that. So we take the square of the differences, and then we take the average of that. So we're looking at the average squared difference from the mean. And then at the very, very end, what we do is we take the square root of that. So hopefully you had this in your stats class. Very simple formula, but it's one we'll definitely be using and understand. But you need to understand what it's telling us. Our focus here is on the distance from the mean. So if we're going to use historical numbers to forecast the standard deviation of something, we're assuming that the distance from the mean we've seen in the past will be the same going forward. And I'm going to show you later in class when we look at some actual real-life data. I'm going to show you that that definitely is not the case. We'll be working some examples in here, and I'll give you the data. But that's standard deviation. Value at risk, I'm going to leave that to later because we're going to do a bunch of that with value at risk. You should have had some value at risk in 3013. You might have forgotten it by now. You will definitely be seeing it a lot in paper 1. So we'll definitely get into it when we talk about paper 1, and I'll help you with that. And then correlation. Well, correlation, guess what correlation does? It takes xi minus x bar. Just like we did for standard deviation, except for with correlation, we have 2 asset classes. So we're also going to take that, and instead of squaring the difference, so here we're multiplying the difference by itself. Here we're not going to multiply the difference by itself, but we're going to multiply one difference by another difference. And the key here is, our focus here is when x is above its average, is y generally. above its average. So that's the key. So think about if they're both above their average at the same time, you'll get a positive number. If they're both below their average at the same time, you'll get a positive number. You multiply a negative by a negative. If one's above when the other one's below, you'll get a negative number. So you take all of that and you just take, again, you take the average of that. See how much this formula looks exactly like standard deviation. So up to that point, it's almost the same formula, except for you have two asset classes. And then you take all of that and you divide it by the standard deviation of x times the standard deviation of y. One thing I'll mention here, and this is important, is this first part of the formula. Hopefully you remember this from your stats class. This is called covariance. Covariance is the average of those multiplied, the average of those product differences. So correlation is the covariance divided by the standard deviation of x times the standard deviation of y. Another formula you should know off the top of your head. I tell students this. I know a lot of students took stats and they just forgot these formulas. I say don't forget these formulas. I think I got a couple of promotions just because I knew these formulas and no one else had bothered to learn them. And because I knew them, I could do things. I understood the formulas. I think it's really, really important you know these formulas because the theory of finance is in the formulas. Well, you want to know what correlation is telling you? Correlation is looking at, hey, when something's above its average, is the other also above its average or not? So I probably have one too many parentheses there. All right, so there's correlation. It can range from -1 to +1. -1 is perfectly negatively correlated. We refer to that as a hedge. We'll talk about hedging later. I don't know why Bill Gates doesn't like that. And then 1.0 is perfectly positively correlated. And then we get to r squared. I don't have r squared in here, but r squared, we'll use r squared, is correlation squared. And so I have, you'll definitely see it when we do this information, this stuff here, we'll use r squared. But what r squared tells you is how much the volatility in x can be explained by the volatility in y. And obviously it ranges from 0 to 1.0 because we're squaring it, so you can't get any negative numbers. All right, so this is data we use a lot in finance. We heavily depend on standard deviation, value at risk, correlation. So now we get the beta. So hopefully you remember beta. Beta is pretty simple because beta is just covariance. The first thing we got to do though is assume y is the market. If y is the market, then beta is covariance of x to y divided by the standard deviation of the market of y squared. So you notice beta is exactly the same as correlation, except we don't divide by the standard deviation of x times the standard deviation of y. We divide by the standard deviation of y times the standard deviation of y. Why? Because beta only captures systematic risk. You should have had a lot of beta in 3013 and in other classes. You should be just an expert. If you're an actuarial major and you're not familiar with beta, we'll get into it later in the class. That is a term you should probably look in Wikipedia online and just get the definition there. In Excel, we just it's just going to be the slope of x and y. You just use the slope function. So it's the slope where you're really focusing on y explaining x. So we'll definitely use beta, but not as heavily in this class as in other classes. Then alpha, tracking error, information ratio, Sharpe ratio, and others. This is the project. You'll see these in the project, so we'll get to that. So value at risk, you'll get that in paper 1 quite heavily, and in class. We'll spend a lot of time in it in class. And then the project, you'll get to learn about alpha, tracking error, information ratio, Sharpe ratios. You might have seen some of these before. I don't cover Sharpe ratio in my investment class, but I know other professors do. But we will cover it here. It's just a simple, the trainer index, Sharpe ratio, Sordino ratio. There's ratio. They're very, very simple. So I throw them into the project at the end just to make sure you have exposure to them. But they're very simple ratios, and if you forget them, you can always just look them up. I always get them mixed up a little bit, which one uses beta, which one uses standard deviation, so sometimes I have to look them up. But we'll get into that in the project. And then duration and convexity, especially duration, we didn't get this when we talk about interest rate risk. So we'll definitely talk about duration. We're not going to actually calculate duration like I did in my investment class. I might show you how to calculate it in this class just to make sure you've seen it before. But what we're going to do is take duration already calculated and use it to make decisions using balance sheet immunization, which is by far my favorite topic in finance. I could spend the entire semester on this. I really love it. We'll talk a lot about this with banks, with pension plans, with life insurance companies, with other entities, even with your own personal investing and your own retirement planning. So extremely important. Convexity, we'll just talk to it. We won't actually use convexity in a calculation. But these are other terms you can definitely look up. You want to get some head start. I think I put a paper out there on our Blackboard that has a good academic discussion of duration and convexity, or you can just look them up. Wikipedia does a good job, and if you do Wikipedia on duration, convexity will be a link that you can drill down on and get into more detail. You should definitely be very comfortable. Everything on this list you should be very comfortable with when you graduate. These are all terms they would expect you to know. All right, so my page numbers may be getting off after here, so I'm probably going to the next class. I'll save this as separate notes so I don't lose all of this, but next class I'll go back to the original class notes so my page numbers don't keep changing. So this is probably still page 9, but might be a little bit higher up on page 9. In fact, why don't I do that? So we're getting into some of the calculations that we'll use quite heavily in this class. So we want to just make sure you've had them before, and if you haven't had them before, go back and review them. You should know them already. And if you don't know them, you missed something in a previous class, and you definitely want to become an expert on this. So I can't imagine an interview that you would do for a job, whether it's on the investment side, wealth management side, corporate finance. Well, maybe corporate finance, they wouldn't expect you to know number 5. But the rest of these, they definitely would expect you to know these terms. So get familiar with them. We'll be hitting all of these in this class. So if you're not familiar with them, you'll at least be exposed to them in this class. So what we're going to be doing going forward is using the model we talked about in our second class, to define, measure, mitigate. So we want to make sure we know how to define risk. Then we want to know how to measure them. Well, standard deviation is a measurement. Value at risk is a measurement. Beta is a measurement. Tracking error, information ratio, Sharpe ratio, those are all measurements. Duration, convexity, those are measurements. Credit rating, that's a measurement. So we got a lot of measurements here. And then mitigation, we'll talk about the mitigation. Correlation is a mitigation. I mentioned balance sheet immunization. Balance sheet immunization is a mitigation technique. So what you want to be clear on, and this is real important for paper 1, you want to define the risk. I'm going to give you 2 risks that you talk about. Define those risks, and then you're going to have a section you talk about measurement. And you want to make sure under the measurement section that you're talking about actual measures of risk. And then you're going to have a section on mitigation. So here's how they measure the risk. They use value at risk to measure the risk. How do they mitigate it? Well, they might have limits. Limits is a really popular one for mitigation risk. Or their measure might be value at risk, and their mitigation is correlation. And you'll see that a lot, especially on price risk, where they use correlation or diversification to manage the risk. So what we're going to do starting the next class is we're going to jump into the universe of risk. I mentioned that in the previous class. We're going to use my list. We're going to start with my favorite one, which is interest rate risk. And we're going to define it. We're going to measure it using duration and convexity, primarily duration. And then we're going to use balance sheet immunization to mitigate it. So let me just tell you that so you see the class we're coming from. We're going to define interest rate risk, where they're going to use duration to measure, and we're going to use balance sheet immunization to mitigate. That's where we're going. There's a huge exam question on exam 1 that does exactly that. So this is our model for the rest of the class. Once we finish interest rate risk, we'll then move to price risk, and we'll define it. We'll measure it using value at risk, and then we'll mitigate it using correlation, risk limits, and other things along those lines. So you see where we're going in this class. I'm trying to keep it very, very organized, mainly so you can retain this material, because you're going to see a lot of this very early in your careers. Nothing I'm doing here is out in left field. This is real common stuff, very, very highly likely. If you're a finance major, very likely for you to see this material very early on. If you go to the investment side of finance, you're definitely going to see a lot of this early on. If you're an actuary, your mathematics is somewhat more complex than this. Actuaries do use value at risk. They just don't call it that. And their mathematics is a little bit more advanced than what we'll be using in this class, but the basic concepts are the same. Just because you use a different distribution or a different formula doesn't change what we're trying to do in terms of defining, measuring, and mitigating the risk. All right. So I'm going to stop it there because I don't want to start interest rate risk right in the middle, with just 5 minutes left. So I might go a little bit over the next time. I'll try to average about an hour, but I may go a little bit over next time. But just to whet your appetite, boy, this is an exciting class because it gives you some incredible tools for understanding and mitigating risk.